I'm about to save you thousands of dollars, and that is because I'm going to expose the most dangerous investing strategy out there that I see investors fall for every single day. Let's go ahead and break it down. When you come to investing, when you come to the stock market, you are doing so because you want to make money. I want to make money, you want to make money, and to do so, you go do your research and invest in stocks. Great. There's nothing wrong with that. However, what happens is sometimes you run into companies that are like Carvana. Last year, Carvana was down close to 95%. This year alone, at this point that we're doing this video, it's up 862%. And that sends a message to people that says, look, let me go find the most broke company. Let me find the one that's on the brink of bankruptcy. Let me invest heavily now, and maybe I too can have the next company that's up 500%, 600%, or even more. That is extremely, extremely dangerous. And I, as an investor and someone who's managed over $140 million, who's been educating about investing for more than 10 years, I would rather be wrong. I would rather be wrong and miss a stock that's up 800% than invest in something that ends up being down 90. And here's why. If you lose 50% of your money on a stock, it's going to take you 100% just to break even. If you invest in something and lose 90%, like Mullen Automotive is right now, like Carvana was last year, it is going to take you 900% just to break even. And when you do that and you are wrong, what do you think happens next? Very rarely do people say, hey, look, I lost money. I'm just going to quit. I'm going to go somewhere else. I'm just going to quit and go buy a better investment. What most people do is shoot for the next lottery ticket and the next one and the next one. And instead of cutting your losses and going for a stock that makes more sense, what they do is invest in 1, 2, 3, 4, 5 companies that are all down 90% and hoping and praying that something happens where the stock absolutely explodes. That is one of the worst strategies to investing, and it almost never pays off because it is extremely difficult to find a company that's going to be up 862% like Carvana is. That ain't the way, and the math is not in your favor for doing so. The problem though is that's not what gets clicks on social media. That's not what trends on Twitter. It's not what people talk about on CNBC, because remember, AMC and GameStop, this was that. These were those companies back in 2020. And if you go and look at a chart right now, if you invested in GameStop in 2021, you are still losing money today more than 2 years after, because the math is not in your favor. Investing in companies that are broke and hoping that they are going to continue to rise is not a strategy that is successful for the long term. It is why when I talk about stocks on this channel, it is one of the things I say, hey, look, this company is up X% in the last 6 months. It's up X% in the last year, just to give you context. Because when something is down that much, you are going to need well over that percent just to break even. Okay, just to break even. And once you're in that hole, it is nearly impossible to come back from it. So right now, again, Carvana, if you invested in it back in December, great. For me, fine. I am fine with missing out on a stock that's up 100%. Would I have loved to gotten it, to have picked it up? Yeah, sure, right? Everybody does, but I would rather miss out on that than go hard on a company that's down 95%, like Mullen Automotive is right now, which is a stock that for whatever reason, people absolutely love. And these are the exact same people that fall into this trap. They're investing in a company that is on the brink of bankruptcy. They're investing in a company that they hope becomes the next Tesla, and you're down 40, 50, 60%, and they don't want to get out. Right? But the thing is, once you're down 60, how much do you have to make to break even? Right? How much do you have to make just to break even? That stock can explode by 50% tomorrow and you're still down, right? Because if you lose 50, you need 100. So you're still down at that point. And when is that company ever going to be profitable? When is that company ever going to be good enough for your portfolio to clean up the rest of your mistakes? It's not impossible. It's not impossible, but what are the odds? The best way for you to invest is to shoot for the middle. Okay, shoot for the middle. And what I mean by that is, if I'm looking at Carvana that's up 862%, and I'm looking at Mullen Automotive that's down 95%, right? There's something in the middle here that is probably boring, that nobody is really talking about, and it's doing quite fine. The example for me right now is PACCAR. So they are a manufacturing company. Their stock symbol is PCAR. I've talked about it inside my members only. And just this year, at the time that we're doing this video, it's up 33%. Ain't got nothing to do with AI. Nobody's really talking about it. Nobody cares about manufacturing. And it's just carrying on making me money, right? And nobody is really clamoring about it, right? People talked a lot about Nvidia. People talked a lot about some of these other stocks. And there's one that's just in the middle that has been making money for years. That is where you want to be. That is where you want to be. You want to shoot for the middle, where it doesn't have to be the next great thing, the next Amazon, the next whatever. You don't have to do that. You don't have to do it. It's great if you happen to fall on that thing, but that's not the best way to invest. And I want to give you 2 more examples of how this works. Take Netflix. Netflix is on fire this year. I'm pretty sure by the end of this year, it's going to be one of the top performing stocks, as it is already. But it's probably going to be one of the top performing stocks of 2023. Here's the problem. Right now, in July of 2023, you still down. If you invested at the peak of Netflix about a year and a half ago, you're still losing money. And that's not a bad thing. Netflix can be one of your best long-term companies. However, right now, people say, oh yeah, Netflix is taking off 400% or whatever it is. Yeah, but you're still down. Right? Even take GameStop is one of the perfect examples. If you invested in GameStop at the end of January 2021, it's been 2 years and you are still down. And that shows you how powerful the math is when it's not in your favor and you're investing in a company that has taken a significant beating. Okay? You got to be extremely careful about stuff like that. It's one of the reasons why I'm not investing in Target. Target, for reasons partly of their fault and partly not of their fault, they're down significantly. And if you're investing in Target, after all that's going on, I'm like, look, this might not end well for you because you are going to need 75% just to break even. For example, how likely is a big, large, slow company like Target going to make that level of money for you in the foreseeable future? Or even in a decent future? I'm not trying to wait 17 years for a stock to break even. That's usually not going to help me when there are several other companies out there that can do so much better. So that is the thing. You absolutely have to be careful from that investing strategy, because the thing is, that's what gets clicks. That's what trends on Twitter and Reddit and everywhere else are these super home run stocks, as opposed to the little layup stocks, the free throw stocks, the ones that are consistent and can make you money and score points versus the ones that everybody is up cheering about. All right, so if you want to learn more, you definitely want to check out this video. I covered the top 5 mistakes that new investors can make. So in this video, yeah, you save thousands, you will save even more by avoiding these mistakes here.